the trend a few months ago was all about towards ESG. Has that changed at all over the last 8 weeks as the virus has really taken hold and really wrecked a lot of investors' portfolios?
Good morning, Alex. Interestingly, if we take a look prior to the pandemic, as you mentioned, sustainable investing was already growing. And I think some of the more important factors beyond just performance was that we were seeing positive net inflows into sustainable related funds. And these are truly sustainable funds, not just, say, a fund that has a simple exclusion of tobacco stocks or maybe one of the other quote unquote sin industries, but into strategies that truly incorporate a large number of ESG ratings into how they implement their investment process. So in 2019, it had about 20 billion of positive inflows, and that was versus about 42 billion of outflows that we saw in traditional equity funds. And this continued into the first quarter. So we've seen an annualized rate of about 44 billion of net inflows into sustainable related strategies versus 82 billion of net outflows of traditional equity funds. And also performance has been very strong. So as the performance numbers have started to come in for the first quarter, both with our own experience and kind of our flagship strategies, some of the passive proxies that do incorporate ESG, and of course a lot of our active manager peers in the sustainable space from a median perspective or average manager perspective, we're seeing fairly strong outperformance across the board. So it's been a good environment for sustainable investing overall.
Well, I was going to say, do you expect these kind of retail flows or interest to continue, which would lead me to performance? What strategies have done well if it's not as simple as just like excluding, say, tobacco stocks and coal stocks?
So what we've observed is really two fairly interesting themes. So I think a big positive coming out of the pandemic, if there is a positive, is that companies on average are doing right by their employees. And they seem to really be attempting to balance a kind of employee welfare, employee health, with just running the business. And something that we're trying to be very cautious of as a sustainable manager, and I think other asset managers are doing the same, is not trying to micromanage an executive board or management team when they're looking at very realistic probability that maybe they don't exist in 6 months, right? They have significant liquidity issues. They have significant ongoing concern issues, business operations issues. And so we certainly don't want to be micromanaging them on, okay, well, what are your environmental policies? What is your exact corporate governance structure? So we've kind of stepped back from that. But I think one of the two interesting themes that are emerging, or two of the interesting themes, is that companies that performed well and were rated better on more of an aggregate ESG basis as opposed to a very specific ESG measure, such as just doing well by the environment or just having a good corporate governance structure. These are the companies that have done well during this pandemic period, during this downdraft in the equity markets. So that's given some credence to this notion that, look, if the companies are well positioned in the first place, that when these tail risk events happen, they're going to be much better positioned. And we've seen that come through in performance. I think the second reason, and this is a more interesting one, is that the pandemic is a tail risk type event, and perhaps that there are lessons that we can apply post-mortem once things settle down a bit from a modeling and assessing tail risk perspective. So given this is Earth Day, kind of two very interesting things we're looking at is the significant drop that we've seen in oil demand. Now, it's been over the very short term, and it's really not related to sustainable investing per se, but one aspect of climate change is the negative demand effect shifting to a carbon neutral type economy is going to have on stranded assets. So looking at the effect of this drop in demand over a very shorter time period, are there modeling lessons that we can learn to apply to, say, stranded assets over a very long time period in assessing the negative effect that will have on their valuation? And then the second one is the disruption of supply chain. So everyone's supply chain has been disrupted, right, by the pandemic, and it's related to the pandemic. But are there lessons we can learn for specific companies or specific industries, that maybe relate to, okay, if the frequency and magnitude of, say, extreme weather events is increasing, and that's going to disrupt a supply chain, what lessons can we learn of how maybe better a company can manage going forward its supply chain that's related to that, given how it did during this pandemic period?
Such an interesting point. And this also brings up sort of shareholders versus stakeholders conversation, meaning that if you're a company, you're saying, I'm not going to lay off anybody. I'm providing all this health care and sick care to workers because of the virus. Here are all the steps I'm taking. But that may come at the expense of buybacks or dividends or stronger earnings. Do people want that, or do they just say they want that, but in actuality, they still want the earnings and the buybacks and the dividends?
It's an excellent question, and I think the one aspect of it that doesn't get discussed enough is this notion of time frame. So without question, the way that we manage our strategies, and I think that most sustainable investment strategy asset managers would have the same approach, is this is more of a medium or a long-term value proposition. So, companies just in general. So if we take a step back, they've shifted to having, I think a greater amount of intangible type of asset components, intellectual capital components. There's greater reputational risk because of social media. And so when you look at that, say cybersecurity, of course, and data protection, ESG factors are better equipped to evaluate those things. But what ESG is not some sort of short-term fraud detector. It's not really a good tool for assessing if I invest today, ESG will tell me what the good stock is going to be over the next 6 months. So if you keep that medium to long-term value proposition, then what you see is that better sustainability practices and overall incorporation of ESG factors by company management lead to greater brand loyalty, lower kind of employee turnover, much better alignment of interest throughout, both with customers and employees and even the supply chain. Productivity is improved. And because of that, we think that it's a false choice between, say, shareholder versus stakeholder, is that if stakeholders in aggregate are winning over the medium and long term, that means that shareholders are probably going to win over the medium and long term. Now, it's a fair question that if you take away something like share buybacks, that could be more of a short-term tool that, you're increasing demand in your stock, and also it allows you to manipulate, the EPS number a little bit more. And so over the short term, maybe the stock rises because of an increase in buybacks. But we think, again, it's a medium and long-term proposition. And if you keep that in mind, that the interests are perfectly aligned between the stakeholders, and the shareholders.